In July 2026, a 25-year-old hedge fund manager watched roughly $35 billion disappear from the value of his fund in a matter of weeks. His name was Leopold Aschenbrenner. Just weeks earlier, his fund, Situational Awareness, had reached roughly $45 billion in assets. Then the market turned. Within days, the fund was down dramatically, margin calls were hitting, and most of its public stock portfolio had to be sold under pressure. By the end of the collapse, the fund had fallen to roughly $10 billion in assets. This wasn't a robbery. Nobody hacked the fund. Nobody stole $35 billion from a bank account. This was something much more frightening. The math simply stopped working. And the reason this story matters isn't because most of us are ever going to manage $45 billion. We're not. Most people are just trying to pay rent, buy groceries, and convince themselves that their bank balance will somehow survive the month. But the basic idea behind this disaster matters to anyone who borrows money to invest, buy a house, finance a car, or build a business, because borrowing can make a good outcome bigger. It can also make a bad outcome arrive much faster. And Aschenbrenner's collapse is one of the clearest examples of what happens when that second part catches up with you. The young investor who saw the AI boom, Leopold Aschenbrenner, wasn't an ordinary Wall Street trader. He was a former OpenAI researcher who became well known in technology circles after publishing a massive 165-page essay about the future of artificial intelligence. His argument was essentially that AI was advancing extraordinarily quickly and that the world would need enormous amounts of computing power, chips, data centers, energy, and capital to keep up. The essay became influential among investors and technology executives. Then Aschenbrenner decided to stop predicting the AI boom and start investing in it. He founded a hedge fund called Situational Awareness, named after the essay. The fund attracted serious money from wealthy investors and financial institutions, and for a while, the strategy looked brilliant. The fund made enormous gains by betting heavily on companies connected to the AI infrastructure boom. By early July 2026, Situational Awareness had reportedly reached around $45 billion in assets. Its performance had been extraordinary, but there was a catch. Aschenbrenner wasn't simply buying stocks with cash and waiting. He was using leverage, and leverage is where this story gets interesting. The simplest way to understand leverage, forget Wall Street for a second. Imagine you have $100, you believe a certain type of sugar is about to become extremely popular. So you spend your $100 buying sugar, the price doubles, your $100 becomes $200. You made $100, that's 100% return, pretty good. Now imagine the bank says, give me your $100 and I'll lend you another $300. You now have $400 to invest, even though only $100 actually belongs to you. That is leverage. You're using borrowed money to control a larger investment. Now suppose the sugar doubles. Your $400 becomes $800. You repay the bank's $300 loan. You have roughly $500 left before interest and other costs. Your original $100 has become roughly $500. The sugar only doubled, but your own money multiplied much more dramatically because you're controlling 4 times as much sugar as your own cash could buy. That's the attractive side of leverage. It turns a small move into a much larger result. And when an investment keeps going up, leverage can make a manager look like a genius. That's exactly what happened during Situational Awareness's rise. The AI trade worked. The stocks went up, the borrowed money made the gains much larger. The fund attracted more capital, and the numbers kept getting bigger until the market stopped cooperating. Now reverse the math. Go back to your $400 of sugar. You own $100 of it. The bank owns the other $300 economically because you owe that money back. Now imagine the sugar falls 10%. Your $400 is worth $360. You sell it, you repay the bank $300, you're left with $60. The sugar fell only 10%, but your own money fell 40%. That's leverage. It doesn't just magnify your profits. It magnifies your margin for error. And if the sugar falls 25%, your $400 becomes $300, you repay the bank. You're left with nothing. The asset didn't fall to zero, your investment did. That's the part people often miss about borrowed money. You aren't only betting on whether your investment eventually goes up, you're also betting that it won't fall far enough, fast enough to cause a problem before you have time to recover. And that's exactly where Situational Awareness ran into trouble. The market turns the AI infrastructure stocks that had helped drive the fund's extraordinary gains began falling sharply. Companies tied to chips, memory, cloud computing, and AI infrastructure came under pressure. as investors started questioning how much money was being poured into AI and whether some of those companies had become too expensive. Stocks, including names such as SanDisk, SK Hynix, and CoreWeave, suffered major declines. And Aschenbrenner had another problem. Some of his defensive bets weren't protecting him the way he expected. He had positioned against certain software stocks because he believed they were overpriced. Instead, some of those stocks rose. So he was being hit from both directions. The investments he wanted to rise were falling. Some of the investments he wanted to fall were rising. Without leverage, that would still have been an ugly month, but leverage changes the consequences. Remember our sugar example. If you own the sugar outright and it falls, you can theoretically sit there and wait. Maybe it recovers, maybe it doesn't. But if you borrowed money to buy the sugar, the person who lent you that money isn't necessarily interested in waiting for your prediction to eventually become correct. They want their protection, and that protection is called collateral. The pawn shop. Imagine you own a gold watch. You take it to a pawn shop. The shop gives you $100 and keeps your watch as security. If you repay the $100, you get your watch back. But now imagine the value of that watch suddenly falls. The pawn shop doesn't care that you still believe gold will eventually recover. It looks at the watch and says, this thing is worth less than it was when I gave you the money. So the shop asks you for more cash. If you can't provide it, the shop can sell the watch to recover its money. That basic idea is what collateral does. A lender has something valuable standing behind the loan. And when the value of that collateral falls too far, you can get a margin call. A margin call is basically the lender saying your safety cushion has become too small. Give us more money, or we need to reduce the risk. That's what made the situation at situational awareness so dangerous. The stocks were falling. Those stocks were being used in a heavily leveraged portfolio. Their declining value meant the safety cushion behind the borrowing was shrinking, and the banks wanted more protection. Now, Aschenbrenner had a problem. He needed cash. Fast. The trap gets worse. There was one obvious solution. Sell some stocks, take the cash. Use that cash to satisfy the lenders. Simple. Except when you're managing billions of dollars, selling isn't always simple. Imagine you have 10,000 identical bicycles. Your town normally buys 10 bicycles a week, but today you desperately need cash. So you take all 10,000 bicycles to the town square. Suddenly, everyone knows you're desperate to sell. There aren't enough buyers, so you lower the price. Then you lower it again. The more bicycles you dump onto the market, the harder it becomes to get the price you wanted. That's roughly the problem a huge investment fund can face when it is forced to sell enormous positions quickly. And now comes the terrifying part. The fund sells stocks to raise cash, but the selling pushes prices lower. Those lower prices reduce the value of the remaining collateral. That creates more pressure from lenders. So the fund has to sell even more, which pushes prices down again. It's a feedback loop. Stocks fall. Collateral falls. Lenders demand more protection. The fund selling pushes prices lower. Collateral falls again. More selling. The problem is no longer simply that the investment thesis might be wrong. The problem is that the act of trying to survive the loss can make the loss worse. And that is when leverage becomes truly dangerous. The rescue. By late July, Situational Awareness had to unwind most of its public equity portfolio. The fund needed a buyer capable of taking enormous positions quickly. That buyer was Ken Griffin's Citadel. Citadel acquired a large portion of Situational Awareness's public stock portfolio, with reporting indicating the positions were purchased at significant discounts. This wasn't charity, it was a distressed transaction. Imagine knowing that someone needs to sell their house today, not next month, not next year, today. You are one of the few people capable of buying it immediately. Who has more negotiating power? The desperate seller or the buyer with cash? That's the basic dynamic. Citadel had the ability to absorb a massive portfolio quickly. Situational Awareness needed liquidity, so the portfolio was sold at a discount. Citadel then worked to unwind much of the risk it had acquired through large block trades. The emergency sale helped stop the immediate spiral, but the damage was already enormous. $45 billion to roughly $10 billion. At its peak, Situational Awareness had reached roughly $45 billion in assets. By the end of July, reports put the fund at roughly $10 billion. That's a decline of around 78% from the peak level of assets. Separately, Aschenbrenner reported that the fund lost 67% in July. Those numbers aren't contradictory. They're measuring slightly different things. But either way, the damage was enormous. And here's the strangest part. Despite the collapse, the fund was still reportedly up around 80% for the year after the July disaster. Think about that. Fund can be massively profitable overall and still suffer a catastrophic drawdown. That's one of the most important lessons in investing. A great return doesn't automatically mean a safe strategy. You can make an enormous amount of money using a strategy that eventually becomes impossible to survive. The real lesson isn't never borrow. This is where I would be careful. The lesson isn't that every form of borrowing is evil. People use debt productively all the time. Businesses borrowed to build factories, home buyers borrowed to purchase houses, investors use leverage for legitimate reasons. The problem is what happens when your debt obligation becomes more urgent than your investment thesis. That's the lesson from this collapse. You might be right about the future, you might even be spectacularly right. But if you're using enough borrowed money, you also have to survive the period before the market proves you right, and that changes everything. Imagine you correctly predict that a stock will double over 5 years. Great, but you borrowed so much money to buy it that a 30% decline this year triggers a margin call. Now you're forced to sell, the stock eventually doubles, but you're no longer holding it, you were right and you still lost. That's the hidden danger of leverage. It doesn't just magnify losses, it can take away your ability to wait, and time is one of the biggest advantages an unleveraged investor has. If you own an investment outright, you can potentially sit through a terrible month. If your investment is funded heavily with borrowed money, someone else may decide when you have to exit. That's what makes this story so brutal. Leopold Aschenbrenner wasn't necessarily wrong about the long-term importance of AI. AI is real. The infrastructure investment is real. The companies involved are real. The opportunity was real. The problem was the distance between being right eventually and surviving until eventually arrives. That's the difference leverage introduces. Without leverage, a bad month can be painful. With heavy leverage, a bad month can become a forced decision. And once you're forced to sell, you don't get to choose the price. That's why experienced investors obsess over something beginners often ignore. Risk isn't just how much money you can lose. It's whether a loss can force you out of the game, because if you stay in the game, you can recover. If you're forced out at the bottom, the recovery belongs to someone else. And that brings us back to the $45 billion fund. The extraordinary part isn't that Aschenbrenner made an enormous bet on AI. The extraordinary part is how quickly success turned into a situation where survival became the priority. The same leverage that helped transform a strong investment thesis into extraordinary returns also made a bad month dramatically more dangerous. That's the paradox. The thing that made the returns spectacular also made the collapse possible. So the next time you see someone boasting about an investment that can turn $10,000 into $50,000, don't just ask us how much can I make if I'm right. Ask the much less exciting question, what happens if I'm wrong first? Because the market doesn't care how brilliant your prediction was, and debt doesn't care how confident you are. If the numbers force you to sell before your prediction has time to work, being right eventually doesn't save you. You have to survive long enough to be right. That's the real lesson of the $45 billion bet.